We are back again with Brian Boak of Singer Nelson Chalmers in Teaneck, New Jersey. Brian has been discussing with us some very practical and very important issues of property and casualty insurance, and I think it's been especially valuable to have him expand upon the value and importance of the client intake interview, getting as much information as possible, and even Googling the client to be able to know enough about them to ask some clarifying questions. And often that results in uncovering some aspects of risk that the client may not have thought about. So we're going to continue from our first session with session number 2, and that's going to begin with special exposure insurance. And Brian, I turn it over to you.
Okay, well, welcome back, class, and glad you came to join us again. On day 2 of this property and casualty issue, we're going to start talking about a variety of other issues. We're going to start with special exposures, flood insurance, excess flood, wind, and earthquake insurance. Now, flood insurance, depending on where you're located, may be important or may be a non-issue. But as people in New York recently understood with Sandy that came through, flood insurance is needed in areas that you never thought you would need flood insurance ever before. And they also learned a lot about flood insurance. The basic federal program set up by FEMA provides up to $250,000 worth of flood insurance for a residential building and up to $100,000 in contents. For commercial buildings, you can go up to $500,000 in coverage. Many houses have a replacement cost of more than $250,000, and many houses have more than $100,000 in contents. And most people, and even many agents, don't even know that you can actually buy excess flood insurance. And that is very important to have. And sometimes you can actually buy that flood insurance from the insurance company that is providing your primary home insurance if you work with one of those select upper line companies. Most companies don't do it. But there are several issues that we run into with flood insurance. And it also depends on whether this is your primary residence or is a secondary residence. One of the items is replacement cost. On secondary residences, you're only covered for actual cash value on the building. So that can be a surprise to somebody who has their nice beach house and then they realize that they're going to get a lot less than they think. Also, from our experience, flood claims are paid at a very low level. So we have found out in a big flood claim, it's actually very important to get what's called a public adjuster to help you out, because we found out that 1, they pay very slowly, and 2, they pay very low. And when there are catastrophic issues, such as Katrina or Hurricane Sandy that happened in October of last year, they bring in adjusters from all over the United States because they can't handle that many claims at one time. So they have to bring in other people. And these people may not be used to your costs, what it costs to build in your area, what the values are in your area. So public adjusters can come in handy. Wind insurance. Certain areas of the country, usually around the coast, but there may be, I particularly don't deal in the Midwest, but there may be items in the Midwest, have wind either exclusions or deductibles. So if there's a wind exclusion, like there is in Florida on many locations, you have to buy a specific wind-only policy. And wind policies generally have a higher deductible. It can be anywhere between 2 and 15% of the building coverage. So the deductibles are large, and the client needs to be made aware of it. There are some locations where there is wind coverage, for the example, along the Jersey Shore for me and along the Long Island coast for me also, where wind is included in a homeowner's policy, but there is a anywhere between 2 and 15% deductible, depending on the policy. So you need to make your client aware that in the event of a windstorm, and every policy is a little different, some of them say wind, and they'll delineate that wind speeds over X number of miles an hour, or they might go a named hurricane. So you'd rather it be a named hurricane than a wind exclusion, because at least it's got to get to a certain point before they can put that high deductible on. And our fourth item is earthquake insurance. Now, many people saying, well, we don't have earthquakes in this area. And a lot of people in New York say, we don't have earthquakes in this area. But actually, we do. And we haven't had a catastrophic one in over 100 years, but we have had minor tremors that have caused some damage in the past couple of years. If actually earthquake is excluded on all policies, so you do want to be careful about that. You don't want to be able to explain it to people, and you can buy earthquake coverage back on your policy many times. So that is something to consider. This is an area, fine arts, antiques, jewelry, and collectibles, which can cause your clients problems in lack of coverage. Jewelry is the first big item that everybody has to be concerned about, because everybody has some amount of jewelry. You may not have fine art, you may not have antiques, you may not have collectibles, but everybody's got some amount of jewelry. And with jewelry, there is always a limitation on every single solitary homeowner's policy. I don't care who you got. I don't care if you got the most expensive type of policy that exists. There's a limitation unless you put specific additional coverage on the policy. So there are two different ways that these items can be covered. One is what's called scheduled or listed coverage. And what that means is you have an appraisal or a receipt with a description, and you put a diamond engagement ring which explains the size, cut, clarity of the diamond, and anything else that's on the ring, and a specific value. And that's what that item is insured for. It's already done, it's already decided, this is what it's insured for. And that works the same with paintings and antiques and collectibles and items of that nature. It's called scheduled or listed. Some companies allow you to add what's called blanket coverage on. And blanket coverage is very handy to have because you don't have to have an appraisal for every item, and you don't have to list every single item. And if you sell something and buy something different, you don't have to worry as much. There are limitations on blanket, and that is there is normally a cap on the cost per piece that is on the policy. So that cap may be $5,000, $10,000, it might be $50,000. But they're going to limit the value that they'll pay for each item that is not listed. So if you have items that are over that cap, then those items need to be scheduled and listed in detail with their individual values on there. So you want to know who owns the art and antiques, where they are located, which of your clients' homes are located in, because with some policies that does matter. You want to know if they're scheduled on the policy, and by asking for copies of the policies like we mentioned in our last session, you will know if the items are scheduled. Are they loaned out? That's very important because there could be an exclusion on loaning out. When were they last appraised? Our biggest problem is clients put items on the policy and never look at them again. So you come in as an advisor, the client's got this engagement ring that he bought for his wife 25 years ago. It's been on the policy for 25 years. And the value is 1/3 the amount that it should be because they've never got it appraised. They never thought about having it appraised. They just knew it was insured. So that is an item that you need to be careful for. Items should be appraised approximately every 5 to 7 years, depending on what they are and depending on how their values have changed. Specifically, jewelry, diamond and gold, has increased dramatically in the past 10 years, where your client's jewelry could be heavily underinsured. Now, some policies may have some type of limited replacement cost in them. Some of the companies, such as Chubb and AIG and or Chartis, may have a replacement cost that will replace 125% or 150% of the value if the market value is higher than what's on the schedule, but they do limit it to what is the maximum amount of value you have scheduled. So if you only have one ring scheduled, you don't have any extra coverage. So that's one thing you have to watch out for. Many companies will give you a discount if you have a safe at home, if you have a certain amount of jewelry. If you have very high value items that are worn very infrequently, those items should be kept in a bank vault, because that can save your client a tremendous amount of money. That could knock 2/3 of the premium off. So that is a very important thing to have. We discussed how often they should be appraised, how to find a qualified appraiser, because most people, they bought it from somewhere, they got it appraised somewhere. They may not deal with that jewelry shop, they may have moved, they might have bought art from a place when they were on vacation. If you go to the Appraisers Association of America's website, and that's just one of them, you can use any of the other appraiser sites out there, they list appraisers, and you can narrow down based on the item that you have. So if you have a client that collects African art, you can narrow down. You can narrow down by zip code, within a distance of a zip code. So there's a lot of different things that you can do to be able to help your client out in finding appraisers. And that would be in your report of saying you should have it appraised. Here's where you can narrow. If you don't have somebody that can appraise it, here's where you can find somebody. And we already did talk about blanket and scheduled coverage. Household staff. As people get wealthier, as houses get bigger, they normally need to have somebody help clean the house, run the house, manage the house, take care of the outside property. Sometimes they'll use a service, and if they use a service, then all the insurance responsibilities are on that service. But if they hire that person directly, they need to do a variety of different things to protect themselves. First, they should be on the books. The reason they should be on the books is that way you can get workers' comp and state disability coverage for them, so that in the event that that person gets injured, you don't have to worry about a lawsuit, because it's an employee. They got to go through workers' comp. Unless you purposely tripped them, workers' comp and state disability will protect them. They will pay their medical bills. They will pay a disability benefit. Everybody's disability benefit is different, so it may not be a huge benefit. If they drive your vehicles, they need to be listed on the auto policy, so you are properly protected and they are properly protected in the event of an accident. And then we spoke a little bit about employment practice liability in our last session, but it's very important to bring it up again. When you hire household staff, they are around your house. They're around your house with different people. Not everybody you control. You want to make sure that you are protected in case somebody comes up and says, I was terminated for wrongful termination, or there were some advances made to me that were improper. Whether they were or weren't, you still have to pay to defend yourself. Employment practice liability would provide that protection in reference to payment of lawyers, and if there happened to be a settlement payments. So that is another important item to make sure your client knows exists, because if they know it exists and they choose not to buy it, then they have made a financial decision for themselves, and then you are free and clear to sleep well at night.
Ryan, one of the things that occurs to me in that discussion is you've used as an example a relatively high-end client, someone with staff. And I think I'd just like to make the point that there are relatively few of those kinds of people. Obviously, they're ideal prospective clients. But even in, let's talk about the top 10% rather than just the 1%, the fact that we have a housekeeper come in once a week, that what you've been talking about is as relevant to that situation as to the very high end who have staff.
Correct. It is. The most states, if you have somebody come in once a week, you are not required to buy workers' comp or disability, but it is an option for you to purchase. And it's a relatively inexpensive option to provide protection for you. So it is important that's why we list full-time, part-time, or live-in. So it depends on what your situation is. Those exposures do exist regardless of whether that person comes in once a week or they live in the house at the same place with you. So correct, Dick, that is just as important.
Good, thank you.
If your client hires an outside company for staffing or landscaping or maintenance of the house, make sure that these people do have insurance. You do not want to be the first line of defense. Should somebody be cutting your lawn, they hit a rock and the rock goes flying out and hits some kid on a bicycle, and now you got brain damage. So you're going to get sued. The landscaper is going to get sued. Landscaper has no insurance. You're first in line. You don't want to be first in line for somebody else's mistake. So you always want to make sure that the people you hire have insurance. That way the lawsuit doesn't go directly back to you. You may be brought into it, but you don't want to be the only deep pockets in town. So that is important for you to understand. Cars, motorcycles, and motorhomes. I'm going to talk about motorhomes first because we just had a unique situation. I've got a client that is renting a motorhome. They're going with another couple and they're taking a 2-week vacation. He's never driven a motorhome in his entire life, and he wanted me to check what coverage his policies would provide for this motorhome. So we went in, and on his auto policy, the auto policy will actually exclude motorhomes. And it really, I was not even overly concerned about that. I understood that was going to happen. A motorhome is not a private passenger vehicle. It's not the vehicle that is normally designed to be on a private passenger automobile policy, especially as a substitute vehicle. So, like if you rent a car, your liability and your comprehensive and collision will follow you. I mean, there's a gap, and I'll talk about that in a little bit. But with motorhomes, that's not a private passenger vehicle, so you need to buy whatever insurance is available to protect the comprehensive collision and the liability created for that motorhome. And there are plenty of companies out there that sell that type of item. The next item we're researching is, will his excess liability kick in the event that there is an accident? And actually the jury is still out on that. The insurance company has asked for the copy of the motorhome liability policy so they can review that to make sure that they would provide protection above that. So there's a lot of steps you have to do in case somebody's renting a motorhome. Worst case scenario, tell them to buy the insurance. Because you can't go wrong if you tell them to buy the insurance. The worst case scenario can be is you can have double insurance. And that's not always too bad. So in general, in reference to autos, motorcycles, and motorhomes, who owns them? So you want to make sure that the proper person or entity is insured. Who drives them? You want to make sure that all the drivers are listed. If there's children, if there's household help that drive the vehicles, how the vehicles are used so they are properly rated on the auto policy. Are they truly driven just for pleasure? Or are they driven to work like 40 miles? Or is this a real estate agent that drives people around in their cars where you need to have special protection for that company?
Ryan, another question that occurs to me. I know that it's tempting, especially when you're insuring a new car for the first time and you go through the questions about how will the car be used, how many miles per month or year do you anticipate using them, that there's a temptation to be conservative in your answer in the expectation that that might assist in the premium calculation. What are your considerations about that?
We always tell our clients, tell the truth. Because telling the truth is the best avenue, because then you don't have to try and figure it out, and you don't have the insurance company coming back and going, you told me that you drove 3 miles to the train, but you drive 40 miles and you don't take the train anymore. So generally, I haven't seen a company deny a claim because of that, but they could non-renew a policy for fraud. So you really don't want to get in a position, you want to advise the client that his best opportunity is to tell the truth from the beginning. And if it's going to cost him more, it's going to cost him more, but he's going to be covered, and he's going to be covered properly.
Good, thank you.
And isn't that the idea of having insurance, to be covered properly? Why pay $8 when you can pay 10, when 8 you're not going to get any coverage?
Right.
If a client has a company car, we recommend that they put that company car on their excess liability policy. Even though the company has an excess liability policy, you want to make sure that it's on your excess liability policy, just in case. There's no harm in having a little bit of extra coverage to make sure you're properly protected. Also, if you have anything other than a brand new car that has a new car warranty that has towing and road service as part of the new car warranty, you should have AAA Plus, and I actually should put Plus on this slide in our next presentation. Regular AAA will tow you 3 miles for free. Unfortunately, who gets stuck 3 miles from home? You get stuck 3 miles from home, you park it and you deal with it later.
Or 3 miles from the mechanic.
Yeah, or 3 miles from the mechanic, right. Yeah, you never get stuck there. So AAA Plus will tow you 100 miles for free. And I will tell you from personal experience, a 127-mile tow is about $400. So AAA Plus is a very good thing to have. I had regular AAA, and I got stuck 127 miles from my house, and I signed up for AAA Plus on the spot. They said, it's not going to cover this tow. I says, no, I know it won't cover this one, but it'll cover the next one just in case. So.
And Brian, I remember a few years back you're giving that description, so I immediately put Plus on our AAA policy, and wouldn't you know, within a year we had a tow for which I only had to pay for the 4-mile excess of above 100.
So you just saved like $400. That is a great day. Liability on all these vehicles. The first thing you want to do is you want to make sure that that liability limit matches the required underlying liability limits on your excess liability policy. Most excess liability policies require you to have $250,000 per person, $500,000 per accident, and $50,000 or $100,000 in property damage. But you want to look and see what that particular client's excess liability policy requires to make sure each of the individual policies meets that requirement. This is so critically important when the client has vehicles in different states or by different agents. That's when most errors happen, is when there are different agents involved and everything is not tied together. If there's one agent, normally the one agent knows, okay, we have an excess liability policy, you have to have this much liability, cut and dry. But when you got one agent in California and one agent in Florida, or one agent in Colorado or something like that, you could end up with a problem of one agent being used to writing a certain liability limit because that's what his excess liability requires, never asking what is required by the person's excess liability that they have. So liability is key. That can be a couple $100,000 faux pas that you do not want to be involved with. Uninsured and underinsured motorist. This provides protection to your client in the event they get into an accident. They are permanently injured or they're greatly injured, and the other person either has very little insurance or has no insurance at all. Your client can go after the uninsured or underinsured motorist limits of their auto, motorcycle, or motorhome policy. You always want the uninsured and underinsured motorist limits at the same as the liability limits. There's no reason to have any differences there. And also, it's because usually with the excess liability policy, they require both the same limits. Personal injury protection. You want to think of that as the health insurance on your car insurance. Your auto insurance is your primary insurance when you get into an accident. You may have group health insurance, but this is your primary insurance. It is also the primary insurance for anybody else that is in the vehicle. So if you're carpooling, if you're driving your friends out to dinner, this is going to be the primary insurance that's going to pay that medical bill. So you want to make sure you have good coverage. This, in addition to paying just medical bills, it also has a variety of other items in there. There is a disability benefit in there that usually you can buy higher and higher amounts. Like up to, in New Jersey, you can buy up to $700 a week in benefit, and either a 2-year benefit or a lifetime benefit. So there's a lot of different options. Check your state to see what your options are so you can talk intelligently. It's not only for the person, your client, but it's for everybody else there. So you want to make sure you have the right coverage to protect everybody. Deductibles. Remember our discussion with homeowners deductibles. You want to think about this the same way. What is the logical deductible based on what the premium is for that coverage? Comprehensive is fairly a low premium normally, so you don't really need to have high deductibles there, but collision can be a much higher premium. And if you have youthful drivers or expensive cars, you might want to cherry pick your deductibles based on the car, the driver it's associated with. Many times we have different deductibles for different cars based on what that exact premium is. So unlike homeowners insurance where there's one deductible, auto you can have a variety of different deductibles. You want to make sure all the drivers are listed. So you want to go through, and that's when in the beginning you get everybody's names and dates of birth and everything. You find out who's driver's license aged. So when you look at the auto policy, you make sure all the people of driver's license aged are listed. Even if they're away at college, because a lot of people, oh, my kid's away at college, he's never home. Yes, he's home. He's home during summer break. He comes home at Thanksgiving. He comes home at Christmas. They drive the car. They got to be listed. Now, most companies will provide a discount if that student is more than 100 miles away without a car. So there is a good discount there. But that person will still drive the car, so they still do need to be listed on the policy. They can't be taken off the policy.
Ryan, on that issue, let's first talk about a student who is 18 or over, therefore could be legally separated from the parents. And parents might well have a concern about the liability that a son or daughter could create for them through an auto accident. How would you advise such a client to try to create that separation?
Well, one way to create the separation is to have that driver have their own car and their own liability and not drive your vehicles. So if they own their own car, it is insured in their name, not owned by you, not insured by you. That takes you out of the picture because you are no longer the owner of the car or the insured.
We know that insurance on young people can be quite expensive. Is there a significant difference between being separately insured and covered under your parents' policy, having a car at school? So, the liability is there. The question is, how is it priced?
There's a big difference, and for a variety of different reasons. The first reason is, one, you have a youthful driver. You have a youthful, maybe inexperienced driver.
Sure.
Okay. The second reason it's more expensive is you've now gone from a multi-car policy where you're getting a multi-car discount to a single car policy
Okay.
with no specific discounts. Now, to try and reduce your costs, many times you can get, if the student has good grades, they can get a good student discount. They may get a driver training discount depending on their state. And some states also have defensive driving courses that you can take to also reduce your premium. Also, the kind of car that is purchased will actually greatly affect the premium. You do not want to give a 18-year-old child a souped up Mustang. Liability cost is high, comp and collision cost is high. You want to give them a generic car.
But
Something that's safe.
right. So if on their own, they own their own car and they have their own insurance, and they obviously don't have multi-car discounts and other things, but they do have the good student and the things you mentioned. What is your expectation about the order of magnitude of the premium difference? On their own, it might be $2,500. How much less would it be under a parent's policy, all other conditions being the same?
Uh, it could be close to half the premium.
Really?
A little bit more, but could be close to half the premium.
But still a useful conversation to have with parents of children who are coming of age.
Yeah, I mean, most people want to protect their children and they keep them on their policy for a while, but sometimes it's one, too expensive and too much of a liability exposure. But also the other problem is if that child gets into an accident, they're not going to have an excess liability policy because it's going to be hard for them to get one. So there are going to be some situations there. So they're not going to have as high a level of protection.
Okay, good. Thank you.
Uh, Usage and garage location. It's very important that the cars are garaged where you say they garage them. A lot of people will have two houses. They have one house upstate and they live in New York City, and they're going to want to say that all their cars are garaged upstate New York. How do you get there?
Train.
Yeah. So, garaging location is important. It's important to be correct. As I said, I tell all my clients, tell me the truth, I'll tell you the price. That way, in the event of an accident, I don't have to worry about telling you, sorry, you're not insured. That's the one thing I never want to tell my client, you're not insured because you didn't tell me the truth.
Right.
That is not a good thing to happen. Classic cars. Most auto policies cover cars on actual cash value. Some policies will cover a car on what's called agreed value. With classic cars, agreed value is very important because the depreciated value of a '69 Cobra Mustang is about $1,500, where that vehicle may be worth $50,000. So classic cars are important to be insured properly. Depending on how that vehicle is used will depend on how you can insure it. There are certain companies that are specifically designed to insure classic cars that are used either just for shows or on very, very rare occasions. It cannot be your primary car. It cannot be the car that you go drive to the grocery store on a regular basis. It is not that. I had a client that had lived in New York City, hardly ever drove cars, had 3 what you would call classic cars. None of them real expensive cars, but he had a reasonable Ferrari. He had a Datsun 280Z, which was very nice, and a Mustang. But the problem is he had no primary car. So we had an issue with trying to insure these as classic cars because he drove them as regular cars when he had to drive them. They were not garaged and just used for show purposes or items of that nature. toys. Toys of the rich and famous. Yachts, boats, and jet skis. These are big, big liability exposures. Lots of things can happen. People can get greatly injured or killed on these types of items that people think are fun. So, in reference to all these items, same as cars, same as houses, you got to know the basics of them. Year, make, model, how fast the thing goes, where is it used, where is it kept, is it kept in the water, is it kept out of the water, who actually owns the vessel, is there an LLC or a trust involved in this one again? Who operates the vehicle? You want to make sure the proper operators are using the vehicle. Some states require that boaters have a boater's license. So you want to make sure the client understands that. The people that don't have a license should not be operating the boat. When you talk about yachts, the larger yachts, sometimes there's a crew. And as with household staff, you get workers' comp. There is also a workers' comp, like longshoremen's insurance, for the crew of your yacht. So that's very important to have. Where's it going to be stored during the winter? Make sure it's properly stored in a quality place. Liability. Again, you want to make sure that this item is listed on their excess liability policy, and you want to make sure that the liability limits match the requirements. Excess liability. This is the CYA of all. This protects every big problem that happens in reference to a lawsuit. Somebody gets into an accident, somebody drops something, somebody injures somebody, somebody says the wrong thing. Excess liability is your catch-all. That protects everything else. You want to make sure all the locations are listed. You want to make sure all the vehicles and boats and other items are listed. You want to make sure that any trusts or LLCs that own any of those other items are also listed. In reference to limits, people say, well, how much liability should I have? I said, you should have more liability than the lawsuit that you're getting sued for. But unfortunately, we don't know that until the lawsuit happens. So what do? We start looking at how much they make and how much they got. So our minimal rule of thumb is we would like you to be insured for what you got, that what somebody can get. So if somebody's worth $10 million, they should have $10 million in liability. If somebody makes $1 million a year, but then doesn't have any assets because they're newly making that type of money and they're spending it, and you want to look at 10 times their income. So there's a variety of different ways to look at it. There is no perfect way to calculate how much excess liability somebody should have. If somebody's worth $1 million or more, we say they should have at least $5 million of liability, because $5 million worth of liability is not all that expensive. You can probably buy it for between $1,000 and $1,200 to have $5 million in liability. And when you think about it, that's pretty cheap to be covered for $5 million in liability.
Yeah, at your encouragement, I increased mine to $5 million, and I think it cost me right at $1,000.
Right. So it's not a huge premium to pay to get all that type of protection. Where are they going to get $5 million in cash for $1,200 a year? So, and as people's net worth goes up, then our numbers go up. Now, the one item that many people don't understand is once you get above a certain point, like the first $1 million in liability is like $200 a year. So it's cheap. 5 million is about 1,000. And the reason why it's so expensive is so many people have it. Remember, insurance is based on the law of large numbers. The more people you insure, the broader you spread the risk, the lower you can actually price the item, because the less chance that everybody's going to have a claim at the same time. The less people you insure, the more money you have to collect because if somebody has a claim, there are less other people to help pay for that claim through their premiums. So as you get above 10 million, it starts to get very expensive. It starts to, instead of going for $1,200 for 5 million, it's about $2,500 for every 5 million. So, or 2,500 or 3,000 for every 5 million. So it does get expensive. People think that, well, what's the chance of getting a lawsuit against me more than 10 million? It's remote, but the problem is there's not that many people insuring above 10 million. So the insurance company has to collect enough premiums in the event that somebody gets that judgment.
Ryan, just to be clear, as a term of art, we're talking about what's known as umbrella coverage. Is that correct?
Umbrella or excess liability, correct. And they call it umbrella coverage or umbrella liability because it is an umbrella that goes over the limits of your other policies. So you have to have what's called your base liability or your primary liability on your auto, your home, your boat, and all those other items, because that's your first level of protection. The umbrella policy or excess liability policy has a very large deductible, like 100,000. The deductible on the homeowner's part liability might be $100,000, or it might be $300,000, or it might be $500,000. On the auto, the deductible on the excess liability might be $250,000, or $250 per person and $500 per accident. That deductible is paid for by the primary liability. So that's why you have to make sure that those liability policies that you have on your home and your auto and items like that have the right liability coverage, because the excess or umbrella policy will only pick up after that limit. So you don't want that sublimit to be able to come out of that client's pocket. You want it to come out of his liability policy. So that's why I stress so hard in the beginning that those liability limits be proper. We spoke about uninsured motorist on your auto policy. You can also get uninsured motorist on your excess liability, on some excess liability policies. Not every company offers it, but some of the upper line companies like the Chartis and the AIG and the Fireman's Fund and the ACE and items like that, they allow you to put excess uninsured motorists. And normally you can get another $1 million worth of excess uninsured motorists for a reasonable price on the policy, and that's a good thing to have. You may be able to get charitable directors and officers insurance as part of your excess liability policy if you're on board of directors. And then you also might be able to get the employment practice liability, which we spoke about a couple times during this and the last session in reference to household help. There's a variety of other different programs that you can buy. These are not normally bought from the people you buy your home insurance with. One is ID theft. ID theft is a very big problem nowadays with all the items going out in the mail. All these credit card offers, people throw their mail out, people go through the mail, they take the credit card offer, they change the address, they build up a credit card bill, and then all of a sudden somebody tracks you down saying, you owe $10,000 in credit card debt. And you're like, what are you talking about? All my bills are paid. I don't have a Bank of America card, Visa card. Oh, yes, you do, and you've been spending it for the past 2 months. And then all of a sudden they realize. So there are certain ID theft programs that you can get that will actually monitor your credit through the 3 credit agencies. And what will happen is anytime somebody tries to access your credit, and anytime you apply for a credit card or a loan or a mortgage or anything like that, they check your credit agencies, how your credit report's doing. So when you get a hit on your credit, you get notified by this ID theft company, so-and-so looked into your credit. Now, if you know about that, then you go, fine, no big deal. But if you're like, I didn't get a Kmart credit card, so you can get that stopped pretty much immediately. And the sooner you can start working on an ID theft issue, the easier it is to clean it up. And the way these companies work is you don't actually have to do the work to fix the problem. What you do is you sign a limited power of attorney, and then they do all the work for you. They do all the fighting, they do all the wrangling and the paperwork. So you don't have to do that. So that's a very good item to have and keeps your credit good.
Now, that's not insurance per se. Different commercial entities offer this. I know that Chase offers it. I know that American Express offers it. There's LifeLock. Do you have any experience specifically with those kinds of programs? They tend to cost between $10 and $12 a month. Is that worth it?
We do use a couple of different companies. I don't like to advertise for them, so and we don't know what's available in your area. But we do use a couple of the different identity theft companies, the ones that do the monitoring, the ones that take care of the problem. Many homeowners insurance policies provide ID theft coverage for like $25 for the year, but the problem is those are only reactive and limited use coverage.
They're not getting a direct feed from the credit companies.
They don't monitor your credit, and all they do is reimburse you for some expenses associated with you fighting to fix your credit. They don't actually fix the credit. So you want to use somebody who actually monitors your credit to make sure that when somebody has a hit on your credit, you are notified about it so you know if you need to do something or not. And if it is actually a breach in your identity, you hand it over to them and they take care of it. That's what you want.
Good.
When you if you have car insurance and you rent a car, people ask me, do I need to buy any of the insurance? And the technical answer is, if you have car insurance that has comprehensive and collision coverage and liability, then technically you do not need to buy any of their insurance. But, and I'll go into the but in a moment, you have liability on your auto policy, and when you rent a car, your policy will provide you liability, or at least it does in all the states that I know. You want to check your own states to make sure, but as far as I understand, all the states will provide liability for a rental car, because you're not driving your car at the moment, you're driving a replacement car. They will also extend the comprehensive and collision to that car. But what you do have is, in the event of an accident, by signing away and choosing not to take the rental car company's collision coverage, you have signed your rights away on what they can do with the car. So basically, let's say you get into a front end accident and you break the front axle, and you've just rented a $40,000 car, and there's about, we'll call it $10,000 worth of damage to make it a simple number to deal with. So you have a $40,000 car, it's got $10,000 worth of damage. The rental car company says it's front end damage. We don't want to deal with renting that car. It could be a problem down the road. What we're going to do is we're going to sell it at auction. So they sell it at auction, and they get $25,000 for that damaged car, because they sell it as a damage. It's completely damaged. It's not repaired yet. So they get the $25,000 from the auction price. They get the $10,000 from your insurance company, because there was $10,000 worth of damage and your insurance company stepped up to the plate and paid that. But there is a $5,000 gap, and that's what's called a diminution of value. The rental car company wants to be compensated for that diminution of value. Your car insurance policy has no coverage for that. Your American Express card has no coverage for that. Your Visa card has no coverage for that. What they do is they charge your credit card for that amount of money. And we know it happens because we've seen it happen. So the only way to solve that gap in your coverage is to buy that loss damage waiver, that collision coverage. And many people, oh, it's expensive and stuff. Yes, it is, but it's the only way to cover that gap. So as long as your client knows about it, then they can make a financial decision on what they want to do. If they have no clue about it, then you're making financial decisions for them, and that's not what we want to do. Travel insurance. Travel insurance is designed when you book one of those big non-refundable trips, like with one of those all-inclusive, not the all-inclusive resorts, because they're normally cancel or reschedule, but those charter trips where you're going with 40 people and everybody's going on the same plane and everybody goes into the same hotel and it's not rebookable because it's all locked in.
Or a typical cruise.
Or a cruise, correct, where it may not be refundable. So you want to buy, or the safari that your client goes on where he spends $20,000 for the safari. You can buy travel insurance and it will reimburse you, and depending on what policy you buy, for a percentage of the cost. A large percentage, like 75%. So you get most of your money back, which is pretty good. Now, one thing that you really want to make sure when you buy travel insurance is you want to buy travel insurance that says cancel for any reason. Because many times it's if you buy the regular travel insurance, it's cancel just if you get sick. But we had an example where one of our clients, they were going to rent a sailboat for a week, large sailboat with a crew. A couple of couples were going down, and what happened was their son, who was not going on the cruise, okay, got into a skiing accident and broke his back. Without cancel for any reason, they would have been out the money. So cancel for any reason is very, very important. We've had to use that a few times with our clients where if they had the regular policy, it wouldn't have flown. So when you buy travel insurance, cancel for any reason is worth it. It adds about 50% of the cost to the policy, but you don't have to worry about it if your mother gets sick and you decide not to go, if whatever happens and you decide not to go. So, and normally you have to cancel within 48 hours of the trip. So you can't just 5 minutes before go, I'm not going. So there are some limitations there. Medical evacuation coverage. You have clients that travel. Sometimes they could get injured. If they get injured and they're hospitalized, a medical evacuation program will fly them from the hospital that they're at to the hospital of their choice. And if you got somebody that goes on a safari or goes to Kenya or goes to Thailand or goes to China, these people want to be home if they got some major condition that they got to deal with. So this medical program, which is not insurance, it's just kind of like a prepaid item, and it's about $300 a year for the family. And we have plans that you can buy for every different ages. So there's a lot of different options there. But for example, if somebody was fell off their elephant in safari and broke their back, it could cost them $120,000 to fly home. Medical evacuation coverage, $300 a year. Big difference. There are a couple of concierge health programs. These can be purchased a variety of different ways, and what they are designed for is one, either to monitor and track your health, or in the event of one of those God forbid diseases where you need to have the best people, you want to have the best people and you want to get into the best people, they have connections with all the best hospitals and the best doctors, and they can get you appointments to people that you didn't even know existed. So that's an important item to discuss with your clients. Clients that travel, kidnap and ransom coverage. In some countries, kidnap and ransom is a business. They're going in, and Mexico is one, South America is another area where it's an actual business that is run. They do not go in, they don't want to kill the person, they just want the money. So they'll go in, hold them for ransom, collect the money, let them go. But kidnap and ransom insurance for people that travel extensively is an important thing to consider, to let them know exists. Because if you don't let them know exists and then they have an issue, then shame on you. Now we're going to get into a little bit of a case study. We're going to bring some of these problems that we've discussed into play. So we have Joan and Bill. They've done some estate planning. They've transferred some of their assets. We're going to run into some insurance issues, and we're going to find some solutions. So Joan and Bill are both in their late 50s. They've done an estate planning session. They've transferred $6 million in assets to a trust, and these assets include a $3.5 million home, $500,000 worth of artwork, and $2 million worth of investments into this trust. They appoint Joan's brother Hank as the trustee. Unfortunately, the lawyer, who's the one that should have thought of this, okay, or the CPA, one of those two should have thought of this, but they never alerted the insurance agent of these changes. There were no changes made to their insurance policies, and Bill and Joan are still the named insured of their policy because they think they still own their house, kind of. And they didn't know there had to be any changes done. We have a problem. There's a house fire. And as you can see, this house is on a pretty large piece of property. There's no fire hydrants in the area. It takes a while for the fire department to get there, and the house burns down. All caused by an electrical issue. So the house is a total loss. It cost $3.1 million to replace the home. It costs $500,000 in additional living expenses while they're rebuilding the home, and they lose $920,000 worth of personal property, including the artwork. The adjuster asks a simple question: can I see the title of the home? Then the adjuster rips up the check and writes him a check for $920,000. And Joan and Bill freak out. Neither the trust or the trustee is insured under the homeowner's policy. So the dwelling that is owned by the trust has no insurance at all. So the structure, which is owned by the trust, which Joan and Bill transferred, for all intents and purposes, that is equivalent to selling the house to a stranger. If that stranger never got insurance, Joan and Bill's policy wouldn't provide any insurance for that stranger. So this trust is identical to a stranger. It's another entity. So the house was not insured. The artwork, remember we said, was also transferred to the trust. And the idea of transferring it to the trust is so that it was out of their estate, and then when they passed away, they wouldn't have to pay estate taxes and all that items. So the art was not insured. The $420,000 in contents coverage, the insurance company couldn't document that the contents was transferred to the trust. So they get compensated for the contents. And since there was a homeowner's policy and Joan and Bill were the named insured on there, and there was additional living expenses incurred, the insurance company agreed to pay that. So they paid the $500,000 in additional living expenses. The client has a loss of $3.6 million for not putting a free endorsement on their homeowner's policy. Unfortunately, that's not the end of this story. Their neighbor Connie was over there, gets trapped and suffers third-degree burns over 68% of her body. She's got $65,000 in medical bills. She misses 4 years of work, and she sues Joan and Bill and the trust for $1.8 million. This is not a pretty picture. It costs $500,000 to defend Joan and Bill and $500,000 to defend the trust. There is an award settlement. Connie does get her $1.8 million. The judge decides to split it equally between Joan and Bill and the trust. So Joan and Bill have a $500,000 defense bill and a $900,000 settlement bill. The trust has the same problem. Now let's see what happens. The homeowner's policy and their umbrella policy pay for the defense of Joan and Bill. The trust has to pay $500,000 for its own defense. That's coming out of that investment money that was in that trust. The homeowner's policy and umbrella policy pay for the settlement on Joan and Bill's behalf, but the trust was not listed on the policy. So the homeowner's policy will not pay the judgment for the trust, that $900,000. Connie's attorney secures the $900,000 of investments right out of the trust. Cut and dry. No insurance, deep pockets, take the money, we're clean to go. This all could have been solved by asking the right questions to the right people and having the trust added to the policy at no additional cost. This is the key to asking all the questions. Who owns? How they're used? Where is it? What happens? The more questions I ask, the more I learn about my client. The more I learn about my client, the better I can advise them. The better I can advise them, the better they can be protected, the happier everybody is going to be. Insurance coverage needs to fit the needs of the policyholder, not the needs of the insurer. The insurer is going to issue a standard policy. It is up to the insurance advisor to design that policy to custom fit the insured for their particular needs. Not every insured needs every feature and benefit on a policy, but many times they need some additional riders. Your job is to help the client decide what they need and what they don't need. With that, we'll open it to questions.
Great. Well, Brian, thank you. First of all, I think that was at a very practical level, extremely helpful for all of us to appreciate the complexity and to, if nothing else, I think it, other than the few people who might actually choose to acquire this as a specialty practice, we're going to need to find people in our local communities who have Brian's level of expertise and can bring that to play on behalf of the client, and that the role of the CFP planner is not just to check that off the list. Oh, you're talking to Brian? Fine, let's move on to estate planning. That this is something that the planner needs to be actively engaged with the, in this case, property and casualty professional and the client in many ways to facilitate the client asking questions that they may not know how to form. So it's important that the CFP planner know the client well enough to be able to pose a question on behalf of the client. So shifting to just some general questions that occurred to me, Brian, in the course of your presentation, I'm curious to know what the most frequent underinsured or uninsured risk you've uncovered in your regular or fee-based audit.
Normally it's excess liability limits are low. You come in, you got somebody that's worth $5 or $10 million, they've got an excess liability policy, they hand it to you, it's $1 million in coverage. The second item is jewelry and art. And the third item kind of bounces back and forth on just other additional exposures that they don't know about. It could be flood insurance or a variety of other items. But excess liability is one of the biggest gaps we see people having. They just they don't have enough coverage. And they don't have enough coverage because they have an excess liability policy. They're good. Or the other problem is they're with like a State Farm and Allstate, and there's nothing wrong with those companies. There's nothing wrong with those companies, but they have their fit. And many of them won't go above $5 million in liability. And you got a guy that's really wealthy. He may not have a big home, but he's got a lot of money. And he has not moved on to the understanding that you may have to pay a little bit more to get the right coverage. Um, One thing I want to bring up is, as Dick had mentioned, that you should talk to some property and casualty agents. You want to talk to agents that have access to multiple companies versus the person who is what's called a captive agent, works for one particular company. And it's not that they're not qualified. It's just that somebody who deals with multiple companies, especially the higher end companies, will end up knowing more options that are available out in the market versus the person that works for the single company is only going to know the options that are available for that particular company. So that's the important thing. They may not know that excess flood is available. They may not know that blanket jewelry coverage is the appropriate thing for him because their company may not offer blanket jewelry coverage, or their company may not offer uninsured motorist on the excess liability. So that person is only going to be able to recommend stuff that they can actually sell that they were taught. So
It's also really important to, at the level where you start working with wealthy clients, that often it is not and should not be about where do we get the lowest premium, but where do we get those specialty coverages at the high end, which aren't typically offered at the low end. And it's all about, there's a handful of companies, and I'm going to invite you to name them, Brian, that specialize in these very high end property and casualty situations. So would you take just a couple of minutes and talk about Chubb and Fireman's Fund and anybody else?
so basically there's 4 or 5 top companies that work in this area. There is Chubb, Ace, Fireman's Fund, Chartis, also may be known as AIG, and they may go back to AIG. And there's a company that's available in limited areas, and it's a company called Pure. Pure is a company that started about maybe 6 years ago. Don't know the number off the top of my head. They started down in Florida because Florida had a huge problem of writing, and still has a huge problem writing insurance for homes. So what Pure did is they were old AIG people and from some other companies, and they said, we're going to start a company and we're only going to insure fairly new, well-built homes with replacement costs of $1 million or more. And the reason they did that is those homes were generally well protected for hurricanes, and that was the big problem that everybody was having insuring for. They're well cared for, they're new, and they have a lower claims ratio. So they said, we're going to cherry pick the best of the best. And that's how they started their model. And they've started progressing up the East Coast. They went to North and South Carolina. They're now in New York and Connecticut and New Jersey area and up here. So they're expanding slowly, but they're only designed for the upper level homes. So, and may not be available in your area. So these companies have the built-in coverage of everything that you would create a rider for. So, for example, their loss of use is actual loss sustained versus a number. Okay. Personal injury is standard, which is the libel and slander. That's standard on a policy. Water backup, standard on a policy. Some of the times you can get flood insurance actually on the homeowner's policy. And when you get flood insurance on the homeowner's policy, you have much better coverage because you gain loss of use and a whole bunch of other stuff. You gain a replacement cost, you gain a much better policy. So the policy is going to be a little bit more expensive, but if you've got a client that's wealthy, the question is, do you want to buy the cheapest insurance, or in the event of a claim, do you want to be properly protected without having to bicker back and forth with the insurance company why the why the rug in your bedroom costs $40,000? That's the key. These upper level companies they're used to dealing with claims. They're used to dealing with wealthy people. They want to get the claim done and over with so they can move on and continue. They don't want to bicker around over something. They're going to put you in the correct location. They're not going to put you in a Holiday Inn because the client is not used to a Holiday Inn mentality. So it is important to have the right coverage so that when the bad stuff happens that you bought this insurance for, it's not a bad taste in your mouth. And that's how it works, Dick.
And so this is another aspect of the value of the CFP planner being well enough informed um, at the 30,000 foot level. We're not expecting that you're going to remember each and every nuance of these different kinds of coverage, but that you know enough to be able to take the client to the right property and casualty professional broker and then oversee the process to make sure what you know about the client, those needs and issues and the subjective as well as the objective issues are being addressed. So thank you, Brian. Another question, I think I've related this scenario to you in the past. A very close friend of mine, I was in business with him for many years. His wife had a very unfortunate auto accident that the Department of Motor Vehicles determined that she was at fault in turning left into a driveway, hitting another car. The driver of that car was a 19-year-old man who's, because of the accident, became a quadriplegic. The family, of course, sued. Now, as the attorneys for the family investigated the wife and my friend, they had the perception that they were wealthy. They had a vacation home in Tahoe. They had an apartment in San Francisco. They lived in a very high-end neighborhood in Marin County. He had a successful consulting business. They were sued for $15 million. They had $5 million of umbrella liability. And at that time, he had the impression that he could not have purchased more. He purchased as much as he was told he could have. You do not want to let this kind of situation go to trial because of how juries tend to act emotionally or react emotionally. When of course, they bring in a hospital bed the quadriplegic. So this was settled in mediation, and essentially, other than their qualified retirement plan accounts, that in addition to the $5 million, every penny of their net worth was wiped out. How do you insure against that? Or what are the things you can do? You do everything that you think of doing, including having a certainly respectable, if not high-end umbrella, and nonetheless you get wiped out. It would be easy to consider the question, why bother? Because if he had had no umbrella, he wouldn't have been any further out of pocket.
Well, that's why you need to ask the questions. That's why you need to go and have your insurance reviewed by an independent person that has access to many markets, because probably this person was insured with a State Farm or an Allstate or something like that, and $5 million was the most that they could get. But if he had his insurance reviewed by an independent person, he would have looked at it and go, 3 vacation homes, successful business, you can get more coverage if you want, it'll cost you X. Then he would go back to his agent and go, I was recommended to get more, I can't buy more. Okay, then go back to the advisor. Okay, I was told I can't buy more, what can I do? Well, there's a couple ways you can solve that. There are companies that write what's called excess on excess liability. So you can buy, without having to switch your homeowner's policy or anything like that, you can buy excess on excess liability. Or you might determine, now it's time for me to go to a company like a Chubb and a Chartis, a Ace, a Pure, that's going to write me 10, 15, 20, 50, $100 million of excess liability. Write me what I need.
Yeah. So if you're worth 3 to 5 million, and you would naturally have a 5 million umbrella, and you hear about this situation and you're concerned. So, let's assume he bought an excess over excess for 20 million, but the family sues for 30 million. I mean, how do you make the estimate of how much is enough and appropriate?
Judgments in that realm that you just mentioned are very rare, and very hard to make stick. Um, I'm actually surprised the $15 million stuck.
Again, remember, it was a mediated settlement because
Yeah.
the defendant's attorneys advised that you do not want to let this go to trial.
Well, you couldn't have done any worse if it went to trial because they took all the money.
Yeah.
Really. Um,
It's a horror story
yeah,
that
it's a
you
hard.
would not
There's
expect
no
to
way to
start with.
solve it.
Yeah.
There is really no way to solve it. There is no exact answer because if that person was worth $3 to $5 million, depending on what his income was, okay, the normal recommendation would have been a $5 million umbrella.
Yeah,
That
his
would have been
income
the
was about
normal.
500,000, so that would have indicated 5 million. His net worth would have indicated 5 million.
Um, but with his if his income was 500,000 and he was worth 3 to 5 million, then we would have been kind of approaching the next level at that point because he had
Okay.
a good income and good assets. So
So this is instructive of the level of sensitivity that we need to have with our clients, and not necessarily that we're trotting out horror stories, but to the extent that we might anticipate that such a situation would be especially sensitive in a given situation, you at least want to explore, um, especially when there are appearances of greater wealth. The place in Tahoe, the place in San Francisco, the place in Marin probably gave an impression of greater wealth than there was. And so to have that exposure might, for a number of people, suggest more excess liability than the formula might otherwise have suggested.
correct,
Would that
because
be a reasonable conclusion?
I would agree. When I looked at the person, if I looked at the person's assets and saw 3 to 5 in assets and $500,000 in income and 3 homes, I'd be looking at 10 because of the long-term way to get money out of this person would be all his assets and his income
Yeah.
in a big situation. So I'd be looking at 10. I really, in reality, don't think I'd be looking at 15. So it would be hard for me to justify 15 for that person. And also for that person, it'd be hard for them to justify paying the money for 15 because now you're talking about 3, 4, 5. You're talking about $6,000-7,000 a year for liability.
Yes.
So that's a big jump for somebody who is making good money, but not like he's raking in millions.
Right. Well, Brian, we're at the end of our time. And again, I just want to express my appreciation on behalf of Cal Lutheran University and Biz 506 Risk and Insurance. You've added immeasurably to our appreciation of the issues of property and casualty, and just can't express enough my appreciation for the time you've taken with us.
Not a problem. Glad to help you out. And as you can see from the slide, my email address and my phone number is on there. If any of the students have any questions, I'd be happy